Hey, what's up guys? Brad here. So today I wanted to do a Q&A, all right? Now, I don't have enough subscribers yet to ask you guys to submit questions and have enough material there to do a Q&A. So what I did is I headed over to Investing with Tom, his channel. And in the community tab, he recently asked, hey, what do you want me to answer questions about in my next video? And so, I got some of the questions from there, and I got some other questions from some Facebook groups that I'm a part of. There's a value investing group on Facebook that's really good, and there's also a Berkshire Hathaway group on Facebook that I really like. And I think that was started by Guy Spear. Anyway, let me know if you want a link to that. So let's jump into the Q&A. Why is there such a disparity between the stock market and the economy? Well, honestly, I have no idea, guys. And I don't think it really matters. If you're a value investor, you're looking for opportunities where you can buy the stock at a significant discount from the underlying business value, okay? That's it. If that situation isn't present, you just wait, okay? Now, Sam Zell did respond to this question in a way that I thought was interesting. And he basically said potential buyers in the stock market are, looking at the state of the economy and thinking, wow, I need a pretty significant discount from current prices before I'm interested in buying, based on what's happening with unemployment, based on how many businesses are kind of set to go bankrupt. It's a pretty scary situation in the economy. And potential sellers are looking at prices that were available just a few months ago, and they're anchoring to those kind of recent high prices. And because there's such a delta between potential sellers and potential buyers, there's just not much happening. There's that disparity between those two camps. So, that's what I'll say about the first question. Question 2, how do you find new investment opportunities? So the way I do it, and guys, I'll be honest, I'm not trying to find 10 new investment ideas every week. I'm really just trying to find a few every couple months. So I'm not eager for new ideas to analyze. I know great ideas don't come up very often. And so anyway, how do I find them? So I look at 13F filings for what's considered the super investors. Investment managers who manage over $100 million are required to disclose what they bought and sold in the last quarter through 13F filings through the SEC. So there's a website called Dataroma, which aggregates all of that information. So you can see, I particularly like Mohnish Pabrai. So every quarter, February 13th, May 13th, every 3 months, basically, on those dates, the 13th or the 14th, that information is released. And I particularly like the investment style of Mohnish Pabrai and his track record. He buys very infrequently. When he does buy, he makes big bets. And he's really looking for opportunities where he can get at least a double pretty comfortably. Like, he has a pretty high sense of probability that the company will double, the stock price will double within 2 or 3 years. And often he's looking for much bigger gains than that. Double is kind of the minimum. So that's one place I look to see what he's bought and sold recently. Another place I like to look is the Magic Formula Investing Screener. Okay, turns out a lot of companies that Mohnish Pabrai has bought in the last several years and end up turning up on the Magic Formula Investment Screener. And the screener, it's really just a combination of cheap companies and good companies. Cheap as measured by earnings yield, and good as measured by return on invested capital. So those are the two kind of main resources I use to find new investment ideas. And essentially, I have a list right now of like 15 great businesses that I'd like to own. And I have prices identified where that is the price I would like to buy into that stock. So that's kind of my list of great businesses that I'm kind of constantly watching, waiting for the price to drop low enough. And then new ideas come through one of those kind of two routes. So that's how I find new investment opportunities. Number 3, are you buying stocks in the market now? So I am not buying now. And I'll tell you, I am kicking myself for not buying back in March. Okay. There were 2 companies in particular, Facebook and Uber, that got below my buy price. Okay. But for whatever reason, I didn't pull the trigger on those stocks. I kind of thought to myself with everything that was happening with the pandemic and unemployment numbers, I thought, well, I'm just going to wait. I'll probably be able to get these even lower, even though they were at such a sweet spot back in March. So that was a lesson for me. And the lesson was, if something drops below my buy price, I should buy something. I don't need to spend all 10% or however much of my portfolio I'm willing to allocate to that stock. I don't need to buy fully into the position all at once, but I do want to kind of ease my way into the position once the price falls below that buy point, which it did for both of those companies. So I am kicking myself. I got greedy. I decided to wait for even lower prices. And I learned from it. I'm not going to be doing that moving forward. But at this moment, I'm not buying anything. I'm waiting for prices to come down. Number 4, what value do you put on tailwinds versus headwinds when investing? So, Charlie Munger mentioned something about this recently. And he said, when it comes to investing, we're just going to swim. Okay, sometimes the current is going to be with us. Sometimes the current is going to be against us. So we're not always going to do well as compared to the market, as compared to a market index. But we're going to do the best we can, and we're not going to take more risk than is prudent for us. Even if every other investor is using leverage to the hilt because the market has been going up for so long and they've lost all sense, any possibility of something bad coming. So they don't look at the macro picture, Charlie and Warren. They don't look at the macro picture, headwinds versus tailwinds. They're looking at specific investment opportunities, okay? And I really like that framework. Because when it comes to headwinds or tailwinds, when it comes to macro factors, it's really hard to predict what's going to happen there. And it's much easier to just focus on kind of business level factors that an individual can actually gain more knowledge on, to the point where it's the return on spending time and energy understanding those things is much higher than on trying to predict these macroeconomic factors. So, I like that line of thinking. I don't really look at headwinds or tailwinds. I'm looking at specific companies and how the value compares to the price. Number 5. There are companies growing earnings at a consistent rate of 15 to 20% per year. Is the price to earnings ratio of 100 justified for these companies? Where that's the case, where they're growing earnings 15 to 20% per year. I don't ever think a PE of 100 is justified. I mean, there's probably situations where you can still do well with a price to earnings ratio of 100. But, from my perspective, if you are paying $100 to get $1 back in earnings, there's just so much potential downside from a situation like that. Why not find other investment opportunities that have a much more favorable risk to reward ratio? Another thing is a company can't grow earnings at 15 to 20% indefinitely. At some point, when a company gets to a certain size, you really just can't grow much more than the rate of GDP. If you look at companies like, big companies like Apple, Microsoft, some of the biggest companies in the S&P 500, it's completely unrealistic to think those companies are going to be able to grow earnings at 15 to 20% per year for the next decade or two. It's not realistic. Okay, as you get bigger and bigger, there's a cap to growth. So, you want to pay attention to that when you're valuing businesses. The way I do it, if a company is growing at 15 to 20% per year, I figure, that's maybe sustainable for 5 years, maybe even 7 years. But at some point, you got to taper off that earnings growth to kind of come down to maybe the 10-year treasury rate, something like that. So that's what I'll say about that one. Number 6, is it really true that 90% of active fund managers trail the index? 90% of active fund managers. I don't know if it's true. It's a number that's getting tossed around. It wouldn't surprise me if that were true. And there's a number of reasons that these active fund managers, why it's really difficult for them to beat the market. One is they have high expenses. They have all of these employees. They usually have, office spaces. They have a lot of overhead. And in order to pay for that overhead, they need to charge fixed fees, what some people call, fees for breathing. Okay, you have to pay them for breathing because they have all of this overhead. So that is a drag on returns for investors who invest with them. Another thing you've got to realize about active fund managers, they're not trying to blow it out of the water with returns. Okay, if they aim for the stars, or even if they have a very concentrated portfolio that has a lot of volatility, they stand to lose a lot of investors in the short term because most investors are very focused on what the fund returned kind of in the last quarter, in the last year, in the very short term. So if you're an active fund manager who's investing in a way that has a lot of volatility, that's a very dangerous situation because your oxygen is your assets under management. It's the fees you're collecting on those assets under management. So really the ideal for an active fund manager is to beat the index by like a couple percentage points per year. And really the only way to do that consistently is to own a lot of companies, have a diversified portfolio of a lot of stocks, and be able to do that, have a diversified portfolio that just slightly beats the index. And that's a very difficult thing to do for a variety of reasons. So I believe that it's true that 90% of active fund managers trail the index. The real question is this an indication that trying to pick stocks is silly? Is it a fool's errand to pick your own stocks as an investor? And while I still think it's hard to beat the index picking your own stocks, individual investors have a number of advantages over fund managers. One is we don't have any expenses, okay? Number 2 is we can ride out volatility, right? Like our returns are based on what our actual stocks are returning, not the assets that we have under management. We're not collecting any fees on the assets under management. So we can take a long-term time horizon and just ride out the volatility and trust that, the basket of stocks that we have, if we can get them at a significant margin of safety, a significant discount from value, and have the patience to wait long enough, we're going to be in a much better position 5 to 10 years from now than we are today. But there's a lot of pressure for active fund managers to perform in the next quarter or in the next year. Okay, that's what investors tend to be looking at in order to stay with that fund. So, I don't think there's much overlap between the success of active fund managers and the success of individual stock pickers. But it is interesting. And, Warren Buffett himself says most investors would do better just passively investing in an index fund. And I think that's probably true. There are a lot of emotional biases that get in the way of active stock picking. Okay? So you really have to know yourself and know what your biases are and understand kind of what the pitfalls are for individuals trying to pick stocks. Really study why people fail with that approach and do your best to avoid all of those pitfalls that cause people to lose money as individual stock pickers. If you study one thing as an investor, study why people fail and avoid those things, and you're going to be so far ahead of the game. Number 7, are there any sectors left that are still beaten down? I want to put more money to work. So, it's funny, I see this with Robinhood investors, how it's like they have to throw money at something today, even if it's a long shot, even if there's a high kind of chance of losing money as compared to chance of making money. When I look at this, I don't look for sectors that are beaten down to invest. I'm looking at individual businesses that I understand that are great businesses. I'm looking for the price to be in my buy range. So the whole one thing this brings up for me, I want to put more money to work. I want to do it now. The thing that comes up is there's this idea that people have about making money, that the more active I am, the more I do, the more money I'll make. And that is far from the truth in investing. It's actually probably the opposite with investing. The slower you are to make decisions, and the more patience you have to wait for great opportunities to come to you, the better off you're going to do. So I would encourage the person who asked this question, are there any sectors that are still beaten down? I would say wait until it's obvious that there's a sector that's beaten down, or that there's a company you've been following that enters your buy range. I would highly encourage you to have patience. Okay, there's no rush to put money to work, at least in my opinion. Number 8, best resources for learning how to do fundamental analysis. How do you determine the value of a business? How do you determine the value of a share of stock based on what the business is doing, what the business prospects are in the future? I really like videos by Aswath Damodaran. He's a professor at NYU Stern, and he's taught valuation, business valuation, for I think 35 years now. And he's fantastic. I've actually taken a course with him. I did an online business valuation course with him for a semester. And there's just a lot of videos he puts out on his YouTube channel around valuing businesses like Facebook, Amazon. He's done Uber. He's done Google. He's just done a ton of companies. Recently, he did Boeing. I think he's done Zoom. So, and just Tesla. He's done Tesla. Going through like how he thinks about how he breaks down businesses in order to value them. It's such an instructive exercise. It's fabulous. So I would highly, and he makes videos when he buys something. You know, probably not every time he buys something, but like for Tesla, he bought Tesla at $180 a share. And then I think he sold at like $640 a share over, I think it was like a 7-month period. And he walked through his rationale for buying and then again for selling. So it's just fabulous that he's so transparent about how he invests and the whole thought process behind it. And I find him very rational. You know, he buys when the value versus price instructs him to buy. And he sells when you know, the opposite is true, rather than getting emotion all wrapped up into. I'm sure there are still emotional biases that play in. He's the first one to admit that. But he tries to understand those to the best of his ability. So I really appreciate that. So check out his YouTube channel. So that's it, guys. My first Q&A video. Let me know in the comments if you have any burning questions that you'd like me to cover in the next Q&A. Smash that thumbs up button if you liked the format of this video. And again, hit that subscribe button. We are on a roll with subscribers. I had 25 new subscribers just yesterday. So I'm really hoping to hit that 1,000 mark very soon. I appreciate any support you can give around that. Anyway, guys, that's all I got. I will see you in the next video. Take care.